Okay, folks, couple of very quick reminders. One is the early final will be next Thursday in KMEC 170, which is classroom towards the very certainly our building. I'll send out the details. If you want to take the early final, I'm thinking of whether I need to even set up a sign-up sheet because it really doesn't matter. There are 170 seats there, which should be able to fit as many people who want to take it early as need to. So if you want to take the early final, just show up at 10 o'clock in KMEC 170, and it'll be 10 to 12, 2-hour final. The second is your project is due next Monday, which is the last day of class. It doesn't have to be in class by the end of the day, and so you'll turn in the entire project right up as a PDF file. Even if you did it as PowerPoint, Word, I don't care, make it a PDF file. It's easier for me to put comments. But the numbers that you are actually going to turn that go into your project, if you can put it into that master spreadsheet, and it's asking for a lot of numbers. You don't have to do it as a group. Let's do it individually because you're done. Go ahead, just tell the rest of your groups I'm not getting duplication of the same line. But I would like to get that by midnight on Sunday. Actually, there are two reasons for the midnight. One is I need the time to work on it, but I'm also going to be taking a flight out of San Francisco at 9 p.m. California time, which is midnight here. And obviously, I'm not going to be able to get stuff coming in after that. And I'll have to work on the presentation on that flight because Monday morning, of course, we'll have our last class. So I need the numbers for the last session. And it is 5, I know this is kind of paltry, but it is 5 points out of the 30 points on your final project are for entering the numbers. So please do enter the numbers so that you get them in there. It's a small point. It's just something to kind of make people put the numbers in. So I have the entire class before it starts. Any questions before we commence? So today we're going to do the last piece of the class, which is talk about valuation. I know some of you are in my valuation class as well, so you're going to be rehearing things that I talk about in the valuation class. But we talked about the 4 basic inputs you need to value a company: cash flows, discount rates, growth rates, and disclosure of terminal value. So we're talking about cash flows. We took the easy route at first. With Deutsche Bank, we said the simplest and most direct measure of cash flow is what's the cash flow you can see, which is dividends. But after our discussion of how companies don't always pay out what they could in dividends, we talked about potential dividends for a bank. Today, I want to talk about potential dividends for a regular company. The easier calculation because the items actually make sense. So I went back and collected the free cash flowed equity for Tata Motors for the last 5 years. And it's actually the easiest of all calculations, right? So I take the statement of cash flows and I take them for the last 5 years. I compute the free cash flow to equity each year for the last 5 years. You're saying, why 5 years? Why not just last year? The answer actually is in the last column. If you look at the last column here, you actually see that the amount of, so basically I take net income, I subtract out net capex, the change in working capital and net payments. Notice how much the reinvestment that they have as a company changes from year to year. 2008, 2009, their reinvestment rate is huge. And I'm not talking about huge in the Trump sense of huge, but huge. It's really massive relative to the net income. What happened in 2008 to 2009 that's causing that significant drop? They bought Jaguar Land Rover. So the reason you go back in time is not because that's somehow a magical panacea, but it tells you what a typical year looks like. You're just getting a sense of how much do numbers vary across time. So what you get as the aggregate reflects something about the entire time. What do I learn by looking at those 5 years? Well, Tata Motors has been reinvesting a lot. 88% of their net income has gone back into the business. Is it good or bad? We'll hold off on that. But I'm learning about the company. So I want to emphasize that the only reason for looking at the past is to get some sense of what the company's been doing in the past. It doesn't mean that they will continue to do it in the future. That's your judgment still to make. Don't get locked into the past and say, if that's the number, I have to use it in the future. You can choose to, or you can choose not to for some companies. But at least I'm getting a sense of what the companies look like over the 5 years. For Disney, I'm going to actually estimate free cash for the firm because I'm going to value the entire business. Now again, notice the subtle difference. When you do free cash flow equity, you start with net income. Why? Because you want to look at equity income to equity investors. When you do free cash for the firm, you start with operating income. I use EBIT and operating income interchangeably. Accountants don't like that. They think of them as different now. I think of them as pretty much the same numbers, operating income. And then I act like I pay taxes on that operating income. Let me explain. You got an operating income of 10,032, and I've adjusted for leases because remember in 2013, accountants are not doing that for me. You don't have to do it now because today's operating income should already have that lease adjustment. The effective tax rate that Disney faced in 2013 was 31%. And remember, effective tax rate is just taxes paid divided by taxable income right out of the income statement. I'm going to act like they pay 31% of 10,032 million as taxes. You see why that's acting? Because you really don't pay that on your operating income, you pay it on your taxable income. That's why this is called an unlevered cash flow. It's unlevered because you're acting like you have no debt. You're computing the after-tax operating income. CapEx was 5,239 million. Depreciation was 2,192 million. And finally, the working capital increase that year was 103 million. Remember, whenever working capital goes up, it drains your cash flows. When it goes down, it increases your cash flows. And this year, working capital increased by 103. So let's see what we can learn from these numbers.
Professor?
Yes.
I ask, working capital, do you calculate that by subtracting all your current liabilities from your current assets and measuring the year-over-year change? Is that?
It's the same definition of working capital we use in capital budgeting, which is non-cash working capital.
Ah, I see. That's where I screwed up. Okay, so remove the cash and then the rest.
Remove the cash and also remove the short-term debt from your liabilities.
Okay, thank you.
So don't take current assets minus current liabilities because it will give you total working capital, which really is not what you're looking for. So if you look at my after-tax operating income, there's my 6.92 billion. That's what I start with. Net capex minus depreciation is 3.6 billion. And remember, when you use net capex, you're basically adding back depreciation and subtracting capex. The reason I like to bundle the two together is that in a sense, locked at the tip. Do you see why? What are you going to depreciate over time? It's whatever your capex is. By linking them together, I avoid making a mistake that I think kills a lot of valuation. The mistake is when people project our depreciation and amortization separately from capex and treat them as separate line items. Here's what can sometimes happen. You put a 20% growth in depreciation and amortization. You put a 5% growth in capex, and over time, guess the depreciation is going to exceed your capex and keep going. By linking the two, I avoid that mistake. So my net capex is 3.6 billion. The change in working capital is 103 million. My free cash flow to the firm is 3.188 billion. Free cash flow is an extremely dangerous word. It's actually said a word. Because people use it all the time in finance. And usually, I have no idea what they're talking about. I always ask, what's your definition of free cash flow? And it's going to horrify what the answers often are. I've heard analysts call EBITDA free cash flow. How the heck did EBITDA become free? You don't have taxes, you don't have capex. This is free because it's after taxes and after reinvestment. It's a cash flow because in a sense, I've added back depreciation and amortization, right? Reducing the net amount. And it's to the firm because it's before debt payments. Free cash flow to the firm of 3.2 billion. There are two other ratios I want to compute that I think will come in useful when I start to value the company. The first is, if you look at the net capex plus change in working capital, it's 3,732 million. As a percentage of the after-tax operating income, that's about 54%. You're saying, what does that even tell me? In 2013, Disney reinvested 64% of its after-tax operating income back into the business. They're still saying, so what? when I project out growth for Disney, this is going to become part of the inputs to estimating growth. Do you see what? For a company to grow, it has to reinvest. If this reinvestment rate were 2%, I'm going to be a lot more reluctant to put a high growth rate for Disney because I'm going to ask, where is that growth going to come from? Looking at the reinvestment rate at least gives you clues on what this company thinks about its future. If a company is really upbeat and optimistic about its future, you should expect to see a high reinvestment rate because they're taking lots of profit. So the free cash flow firm computed, but take a look at it to get a sense of what your company's been doing in the past. Any questions on cash flows? Yes.
Is there a reason why we're using, cash flows to firm for Disney and?
Because I'm going to value the entire business for Disney and just the equity in Tata Motors. As a general, remember that choice we had about is the leverage stable or not stable? But then I gave you this, in general, it's always safer to value the firm because you can change your mind on leverage. Whereas we do free cash flow equity kind of long day. It's much more difficult to change things like debt ratio. If you ever have to choose and you're wondering which one should I choose, just pick the firm valuation. Unless you're valuing a bank, in which case you have no choice but to value equity because debt to a bank is raw material. It's not a source of capital. So any other questions of capital? Yeah.
Just a quick question on the effective tax rate. That's taxes paid as in from the cash flow statement, right?
No.
It's from the income statement.
For the income statement. You know why? Because deferred taxes becomes part of my working capital. So if I consistently hold back on taxes, I'm actually letting the government fund some of my business by using the government almost as a capital provider. Yes.
If you are looking at a company like Netflix, where they might have a little bit less capex, but more like content obligations, would you
Now,
include?
why do you separate the two? Content obligation, debt capex?
That would be my question. So
Don't fall, I'm glad you raised the question because don't fall into the accounting trap of capex as land, building, equipment, factories. For Netflix, its biggest capex is what it spends on content.
Okay.
For Pfizer, what's its biggest capex? R&D. For Uber, what's its biggest capex? Acquiring new riders, right? But basically, this is. So you can already see that the 20th century definition of capex was very driven by manufacturing companies. Unfortunately, accountants have never quite abandoned that base. In finance, we don't care what the accountants think. So our definition of capex is going to be much, much, much broader. And I'll give you one other thing that often gets missed in accounting capex. If you grow by acquiring other companies, which is, it's like capex, right? But it doesn't show up as capex in a statement of cash flows. And if you use shares, it'll show up nowhere in your financials. It's like invisible capex. At least if you pay cash for acquisitions, they might show a cash acquisitions line item. But you pay shares, you're saying, how does this company grow? It's almost magical until you look at the footnotes and you realize how many companies acquire using shares during the course. So we're going to use a much more expensive definition of capex. Capex to me is whatever you're spending to get long-term growth. And for your company, that can be very different. Incidentally, in the spreadsheet that I send you for valuation, I give you that chance to recapitalize things. If you're doing Netflix, if you want to capitalize R&D, you just say yes, and then you enter content obligate costs over time. I essentially convert that into a capex because I have to redo your financials now. Different income, different capex, different set of cash flows. Yes.
Quick follow-up to that. When we did the FCFP for Tata Motors and there was a Jaguar Land Rover acquisition, assuming a part of it was, paid.
I count the whole thing as capex, even if you pay for it with shares.
I'm curious, how did you figure out how's the factoring done for the portion of the acquisition that was done?
Just take the number of shares that are given in the share price at the time of the acquisition. Right, so if you pay a million shares and stock price then was $50, a million times 50 is $50 million.
Your current stock price.
Not the current, the stock price at the time of the acquisition. It's a bit of a pain. Now you can see why valuing companies that grow through acquisitions, especially using shares, is a lot more painful than valuing a company that builds factories, right? Because you, in a sense, have to look past the accounting. I don't think you have a choice. talk about discount rates. This is going to be really quick because we've already covered everything we need for discount rates and valuation. Already told you, we have cash flows to equity. The discount rate uses the cost of equity. We have cash flows to firm. The discount rate uses the cost of capital. Exactly the same cost of equity capital we've talked about all the way through the course. But I'm going to say something that's going to sound strange, given that in discounted cash flow valuation, we spend so much time talking about and estimating discount rates. Is it a crucial ingredient? Yeah, it is discounted cash flow. You can't do discounted cash flow valuation without a discount rate. But having said that, I also think we spend way too much time estimating discount rates and valuation and way too little time estimating growth rates and cash flows. Because discount rates are not where you're going to get huge differences across companies. So I'm going to add a few things about discount rates as we go through, where I will revisit numbers we've already used, but then I'll talk about what you might do differently in evaluation that you don't see in traditional capital. I'm going to value Deutsche with both the dividend discount model in 2008, and then again with a free cash flow equity model in 2016. They're both equity valuation models. So I need a cost of equity. In 2008, the cost of equity for Deutsche was 9.23%. Risk-free rate of 4%, risk premium of 4.5%. Pre-2008 crisis. Much higher risk-free rates, low risk premium, cost of equity of 9.23%. In 2016, the risk-free rate had dropped in euros to 0.1% from 4%. Now, if I leave everything else constant, what's your first reaction? The discount rate for Deutsche should also have come down, right? But actually, the discount rate had risen to 10.2%. Why? Because the risk premium had gone up by October of 2016, and Deutsche had become a much riskier bank. So you're going to see cost of equity in both these valuations because I'm valuing the equity in the company. For Tata Motors, I'm going to revisit a page we did with bottom-up pages. It gets a second use. There I did it to estimate a hurdle rate for Tata Motors project, right? I said they need to make this number. Now that same number is going to do double duty at the discount rate I used to value the equity at Tata Motors. So just reviewing, I started with an unlevered beta for automobile companies, global automobile company. I levered it up using the debt to equity ratio for Tata Motors, the existing debt to equity ratio. And the levered beta that I ended up with for Tata Motors is 0.96. I've chosen to value Tata Motors in rupees. Let me repeat that again. I've chosen to value Tata Motors in rupees. You say, what choice do you have? It's an Indian company. Currency is always a choice. You can value any company in any currency. So if you're valuing a Turkish company, you don't have to value it in lira. You can value in euros, but you have to stay consistent. Here I'm going to value it in rupees. So I start with the risk-free rate in rupees. I know you don't remember it, but that's the Indian government bond rate with the Indian default spread netted out from 6.57%, beta 0.964, and the equity risk premium for Tata Motors reflects where they do this. It's exactly the same number we used earlier on as our hurdle rate. Now will become the cost of equity that I used for Tata Motors, 13.5. And for Disney, I'm going to reuse a cost of capital I've used 3 times already. I used it as a hurdle rate when I did investment analysis. I used it as my starting point when we did optimal capital structure. Remember, I said this is where they are right now. And to compute the cost of capital, I did a bottom-up beta, 1.0013, risk-free rate in US dollars, again, because I chose to value Disney in dollars, equity risk premium reflecting where Disney does business. And for the cost of debt, if you remember, I used the actual rating for this. If you don't have a rating, of course, you have to do that dance for the synthetic rating and a cost of debt. Again, it's the same cost of capital that I'd have used as a hurdle rate and as an optimizing tool in capital structure. Yeah.
I'm just thinking if for whatever reason, if I was trying to value Disney euro, and my question is, you would subtract out the country premium out of.
No, country premium is always going to be there. When you go from currency to currency, what's the only number that will change?
The risk-free rate.
It's the risk-free rate, that's it.
But you will subtract out the portion of
There's no other subtracting out. So basically you replace the risk-free rate in dollars with the risk-free rate in euros. It'll make your discount rate lower because the euro risk-free rate is lower.
But when we took the Tata Motors example of 6.57%, you said the Indian bond rate less the,
Because I couldn't find a risk-free per entity in Indian rupees. In euros, what would you use as your risk-free rate?
European.
The German euro bond, right? Why do we use the German euro bond? Because it's already cleaned up. If I started with the Italian euro bond, I'd have to do the same thing there. So the netting out of default rate has nothing to do with Tata Motors. The fact that I could not find a risk-free rate in rupees, and I think I need one. So my cost of capital. Let me do a pause there. A lot of people in their value companies will use what they call a target debt ratio instead of today's debt ratio. Don't go there. This is not your company. You can't go around replacing companies' existing debt ratio targets just because you feel that. With two exceptions. One is if you're acquiring the company. Remember for Disney, we computed an optimal debt ratio of 40%. You say, why aren't you using it? Because I don't run the company. Bob Iger did. And he didn't like to borrow money. I can't replace what I think the right debt ratio is what they're actually doing. But if I'm acquiring Disney, I can replace the existing debt ratio with the optimal and say, I'm buying the company. I can decide how much debt to take. So don't use target debt ratios unless you're the acquirer of this company. You plan to reset the debt ratio. Or the management gives a clear indication that they're going to move towards your optimal. But even there, you might not start at 40%. You might move to 40% over the next 3 or 4 years. And that's something I want to make as a more general point. When we did capital budgeting, we came up with the cost of capital. And we just left it, right? So if you look at the Disney theme park, we computed the cost of capital. We used the cost of capital for the next 10 years and beyond. For individual projects, that makes sense. But think about what you're estimating as a cost of capital for a company. It's a cost of capital right now. It reflects the company as is. This is not as relevant for Disney, but let's say you're valuing Peloton. The cost of capital right now is going to be high. You know what? Because the company is having trouble with its business model. It's not generating much in earnings. It can't afford to borrow money. And its beta might be high because of operating leverage and all those factors that young companies. So when you start the process, you might say, my cost of capital for Peloton is 9%. I'm going to say that makes sense. But what are you doing on your spreadsheet to Peloton? If you're doing evaluation, you're making the company bigger. And if you're optimistic about the company, you're making it more profitable. Finish the story. So if you're making the company bigger and more profitable, what should happen to the risk of the company? It should go down. And to be consistent, then what should happen to your cost of capital over time? It should start to move towards that of an average company. Make this the rule rather than the exception. If you find yourself valuing a company with a constant cost of capital, it's got to be a very unique company, because what are you telling me about this company? It's in steady state already. So if you're valuing ExxonMobil, you might say, hey, this is it. Things are not going to change. But if I'm valuing Disney, I am nervous about what the future brings in 2022 at least, because Disney Plus is going to become a bigger and bigger part of the company, much riskier, more negative cash flows. And that might lead me to reassess the cost of capital. In 2013, my starting cost of capital was 7.81%. But over time, as I project our cash flows, I am making Disney's growth move towards that of the economy. I am kind of steadying up the company as I go through. And as you go through time, you notice that my debt ratio goes from 11.5% to 20%. Why 20%? Because my optimal is 40%, but I don't think they're going to push to it. Because even in my recommendations, I said, don't go all the way to 40, it's too dangerous. Disney's management, I think, is even more conservative than what I would push them to be. So I think debt ratios will continue to climb, because they've been climbing for the last 3 or 4 years. But I think they're going to continue to climb to get to 20%. You ask me, how do I know? I don't. This is my estimate. I could be wrong in hindsight, but I don't think this is going to make or break my valuation. But the bottom line is my cost of capital starts at 7.81% and over time drifts down towards the cost of capital of an average company. So if you're valuing the company, the beta 1.8 right now, and a zero debt ratio because it's a young, risky company, Don't leave the beta at 1.8 for the rest of time and the debt ratio is 0%. While you make your company bigger and safer and more profitable, because you're at war with yourself when you do that. You're disagreeing with yourself. And when you do that, valuation starts to break down. So after a classgram, we just send you a histogram of cost of capital of companies globally. And a histogram of cost of capital. You know, histograms, right? Basically, I give you the cost of capital, I give you the 10 percentile, the 20. You know why I want you to take a look at that? Because you get a sense of what the average company's cost of capital looks like. And I want you to think about that average company's cost of capital when you think about valuing a company 10 years out. Because your cost of capital is going to move towards that average. Any questions on this context? Yes.
Out of curiosity, just like, what do you do for a company like, let's say, taking an example, let's say Tata Motors, right? Where in 10 years, what India's risk-free rate might look like is very, very different.
You could change your risk-free rate, but it'll actually come with consequences for your long-term growth. So I wouldn't worry as much about that because it turns out to be self-correcting, because whatever you assume about the risk-free rate will also play out in your growth rate and your cash flow. Okay. And you could say, why India? Because right now, for instance, you see a T-bond rate of 3%, and you think inflation is coming back, you might say T-bond rate 10 years from now it's going to be 5%. It has a surprisingly small effect on your value because other things change when your risk-free rate changes.
Professor, could I ask, if you do like a shifting cost of capital over time, would you take into account perhaps like changes in the risk-free rate or the market equity risk premium, or is that like time in the market that is key?
Well, discount rates can change because risk-free rates change. Could risk premiums, equity risk premiums change over time? Could betas change over time as you go to different business mixes? What about the default spread? Yeah, everything can change, right? So you actually have the freedom to change everything. The only thing is you don't want to get mired in changing each input too precisely, because let's face it, you're making judgments about the future. So here's what I would do. I would compute the cost of capital up front. I'd compute the cost of capital at the end. You know what you should do in the intermediate period? Let's say you start at 8%, you want to get to 7%. You have 10 years. What's the easiest way to get from 8 to 7 in 10 years? Go 8, 7.97. Don't play games here. This is not worth finesse, right? So if you sit there estimating precisely what the cost of capital is every year, you're going to waste so much time that by the time you get to the cash flow, you're exhausted, so you make up crap. And made up crap at a precise discount rate still gives you present value crap. I'd much rather that you spend less time on the discount rate, get it out of the way, and then go back to thinking about business models and growth and mind, because that's where you make the difference. So now let's talk about the number that terrifies people in valuation. Cash flows, we looked at the past, right? So when I showed you the free cash flow equity for Tata Motors, you said, where did that number come from? I pull up a statement of cash flows here, here, here. And if you're making mistakes, it's mechanical. Discount rates, we can do this elaborate dance of betas and risk-free rates and risk premiums. By the time we're done, people are so bedazzled by what you've done that they let it go. But then I ask you about future growth. And now I'm asking you to play golf. Right? You say, how do I know? I know what happens at most companies when people try to project out future growth, they run into this problem and say, I don't want to do it. I'm going to let somebody else do it. And you look to people that you think are more informed than you are about the future growth of a company. In the case of a company, who do you usually try to ask to see what your future growth going to be? You ask management. If you let management growth forecast drive your valuation, you're not valuing the company. You're just a financial model who's plugging in numbers the management is giving. Should you listen to management? Absolutely. Should you trust them? Are you out of your mind? Why would you want to trust them? First, they're biased, right? Second, they face exactly the same uncertainties you do. Do you think Peloton's management is some crystal ball that tells them what the future? I don't think so. We overestimate how much knowledge and forecasting power management has. So listen to management. If you're valuing a publicly traded company like Coca-Cola, There's another thing you can look at, right? What other analysts are projecting as growth in your company. You're hoping that the law of large numbers bears you out. You might look at historical growth. That looks like a fact. Last 7 years, they've grown at 5% a year. So we look at management forecasts, we look at analyst forecasts, we look at historical growth. Look at all of them, but ultimately, you are the one who's responsible for forecasting growth. So I'm going to give you an intrinsic way of thinking about what kinds of companies deserve high growth or have earned high growth, and which kinds of companies you have to be more careful. I'm going to go back to basics. For a company to grow at a high rate in the future, it's got to pull off a trick where two numbers have to be kept up. First is they need to be reinvesting a lot of their earnings back to the business. The second is they need to be reinvesting well at the same time. You see why so few companies deliver high quality growth? There are lots of companies that reinvest a lot. They do acquisitions, they take projects, but they don't reinvest well. So they reinvest a lot, not reinvest well, the growth is going to be low to moderate. There are lots of companies that reinvest well, but don't reinvest very much. It takes a very special company to be able to reinvest a lot and reinvest well at the same time. So I'm going to focus, instead of estimating growth, I'm going to focus on those two questions. How much is my company reinvesting and how well is it reinvesting? Now remember, you have two choices, right? You could value equity, you could value the firm. How I measure reinvestment and the quality of my investment is going to be different depending whether I take the equity route or the firm route. If I'm focused on equity, I'm going to measure reinvestment as the percentage of my net income that gets retained by the company. Remember we talked about payout ratios when we did dividend policy? If you have a payout ratio of 30%, that means 70% gets put back. I know this is a generalization, but if you're comparing two companies, one pays out 90% of its net income, and the other pays out only 30%, holding all else constant, I'd expect a company that puts back 70% to grow faster than the company that puts back only 10%. That's a retention ratio. But that's only half the equation. You put back 70%. Second question I'm going to ask you is, what kind of projects are you taking? And from an equity perspective, the way we measure project quality, and I know it's a shortcut, is by looking at the return on equity. Now, one reason I've kind of nagged you to compute the return on equity, the return on capital at your company, is to get a sense of what the past looked like at your company. So let's throw some numbers in. Let's say you're a company that reinvests 70% of your net income back, and you make a 20% return on equity. As you break it, your expected growth in net income is going to be 70% times 20%, which is 14%. I know it sounds mechanical, but in the long term, this is called sustainable growth. If you want your balance sheet to stay balanced and your company keep on blowing up, this equation has to come into play sooner rather than later. If you reinvest only 10%, your retention ratio is only 10%, and you have the same 20% return on equity, your growth rate is going to be only 2%. The companies have to face that trade-off. Do they want to pay a lot out as dividends and stock buyback and grow at a slower rate, or do they want, and I'm not telling you one is better than the other, but some companies growing at a slower rate and returning more cash is better. It's going to depend on the return. If you're looking at operating income, I'm going to measure how much you reinvest by looking at net capex and change in working capital. And I'm going to divide that by after-tax operating income. Notice that we're doing the same thing. We're just redefining whose perspective we're taking. And we measure how well you reinvest with that return on capital. Reinvestment rate, return on capital is expected growth. So let's try this on our company. Let's start with Deutsche. In 2007, Deutsche had a return on equity of 19.45%. I didn't know it then, but this is kind of a high watermark for Deutsche. Just before the crisis, they looked really good in terms of return on equity. In terms of retention ratio, they were retaining about 67% of their net income. The company, they were paying out 33%. In 2008, if I'd assumed they could maintain those two numbers, ROE of 19.45%, retention ratio of 67%, my expected growth in income would have been about 13%. But even in 2008, before the crisis, I was a little reluctant to go with just 2007. The banks go through booms and busts, and I felt like 2007 looked like it was too high to be mentioned. Now, when you worry about last year being unusual, the easy fixes, look across time. If I took the average return on equity over the last 5 years and the average retention ratio over the last 5 years, I get more normalized numbers. I'm not saying one is right and the other is wrong, but one takes a different perspective to smooth things out. So if you take 11.81% return on equity, the 46% retention ratio, my expected growth is 5.4%. So often when you value companies, you're faced with this choice. Should I just go with last year? The most recent year, so that's a good news. So it's updated data. But the downside is last year can be a strange year. It can be really good, really bad. You might be building that into the future. So I would suggest look at things over time before you use last year's numbers, because you might get a better perspective of the company. Yes.
The book value of equity and dividends, you've kept the same as the current.
Yeah, because the dividends are going to be the dividends, right? I can't go back and normalize dividends over time. I can normalize the net income over time and say, am I paying a bigger percentage of that or not? Right? Because they're actually paying that dividend now. So the true retention ratio this year with normalized net income is actually much lower than with the actual net income. Now for Tata Motors, because I'm looking at free cash flow equity, the equity retention reinvestment rate replaces my retention ratio. So instead of looking at the retention ratio, which is a dividend discount model version of growth, I look at the equity reinvestment rate. So here's the good news. For Tata Motors, their equity reinvestment rate is high. Why is that good news? Because they're reinvestable. Their return on equity over that period was so high, I don't believe it. There's something weird going on. No, automobile companies don't make 43% returns on equity, but this can happen, right? You have accounting numbers, who knows what you're writing off, what you're leaving in. So with that skepticism built in, if those retention ratios and returns on equity are right, your expected growth rate is going to be 38, I'm sorry, it's going to be 24, it's going to be 38% with the average numbers. In fact, if I use just the 2013 numbers, I get a slightly lower growth. I think both those numbers are being pushed up because my return on equity is so high. When I asked you to compute return on equity and return on invested capital, I opened the door to a lot of trouble, right? For some of you, your book value of equity was negative. For some of you, you got returns on, I think somebody's doing Microsoft came up with returns on equity of more than 100%. Why? Because the book value of equity doesn't reflect the biggest investment, which is R&D, it's not capital. Returns on equity and return on invested capital are accounting numbers. So when you get a number that looks high based on the return on equity, return on invested capital, you might choose not to use it. You might say, going forward, I don't think that's a reasonable growth rate. But computing something doesn't mean you get locked into using it. So keep that in mind. Anytime you compute something from last year's numbers the last 5 years, you might decide that's not the number I want to use in the future. And what other choices do I have? If you don't trust your company's own numbers for return on equity and retention ratio, it's an automobile company. What could I look at to get a sense of returns on equity and retention ratio? I could look at industry averages. There's a reason I built those industry average worksheets into your valuation spreadsheet. Is I actually pull up, this is what the numbers look like for automobile companies collectively. Be a skeptic on every single number. Collect all the information on your company, on the industry. Bring in all the qualitative things you know about your company, who runs the company, what does they do, and then you make that final judgment. And if you ask me, how do I know I'm making the right judgment? You don't. But then nobody does. You're making your best estimate, given what you know about the company. And finally, for Disney, one more thing on the growth rates in equity income. The ROE becomes this big driver of return of your growth rate, right? High ROE give you high growth rates. There's one little trick companies sometimes play that pushes up their ROE that should make you a little more wary about using the ROE. In a company that takes average projects in the sense they make 9%, not bad projects, they make 9, 10%, 10, can they end up with returns on equity of 40, 50, 60%? Yes, by borrowing enough money. Everybody in real estate knows this game, right? You take a building that makes a 7% return on the total value of the building, and you borrow 90% of the building's value, you can make your return on equity 30 or 40 or 50%. Every private equity investor plays this game when they do a leverage fund. They take the firm, they take a small slice of the firm and make it equity. Your return on equity can shoot through the roof. In fact, mathematically, you can break the return on equity down into two components. The first is the return on capital. Think of that as the true return on your project. You make 9, 8, 7%. The second term captures the leverage effect on return on equity. And it's very pragmatic. Let's say it costs you 3% to borrow money after taxes. Let's say you make 7% in your projects. Every dollar you borrow, you're making a 4% spread as an equity investor, right? Because you're borrowing money at 3, you're making 7%. So as you borrow more money, if you're earning more than your after-tax cost of debt, your return on equity mathematically will always go up. Now, of course, this then leads to a follow-up. Return on equity goes up if growth in earnings goes up, right? If growth in earnings goes up, shouldn't the value of equity also go up? What am I missing in this logic? Because this seems to suggest that companies should just go out and borrow more money because they'll push up the return equity. Pushing up return equity will push up the growth in equity income. Pushing up growth in equity income will push up free cash flow equity cost of capital. But that's not the cost of capital. It's the cost of equity. Cost of capital might actually make me feel like I'm okay. But cost of equity is what I'm using here. And that cost of equity will go up. And what's some mechanism that we use to make sure it goes up? What are the inputs in the cost of equity? Beta. Risk-free rate, beta, and equity risk-free. This is why I've tortured you with this levered, unlevered beta calculation all the way through this class, is because if you don't do that, this seems like a free. Okay? You go out and borrow money, your growth goes up, your earnings per share are higher. What's wrong? What can go wrong? And what can go wrong is you made your equity a much riskier slice of the firm. Your cost of equity should go up. So mathematically, when you see companies high returns on equity, stop and ask the question why. In the case of Microsoft, the answer might be accounting issues. It's not that. But if you take a highly levered firm and you look at a high return equity, it might make sense to actually break down to how much that return equity comes from leverage and how much of it comes from the project. Because the latter is always a good thing. Increasing the returns you make in projects will always push up value. But increasing leverage can actually cut in both directions. Your question?
Yes. Yeah. So I'm looking at Facebook for my
Yeah.
project, and they're obviously investing a lot of money in building out the metaverse infrastructure and all of that, and that's not going to be returning any cash to the company for at least 5 years or so based on the latest earnings, right? So how do we factor something like that? I mean, it's a completely new platform.
It'll push down the current return equity, right?
Right.
I mean, let's say with Facebook, you still have a high return equity because you have 50% margins. Doing that is not good. But let's say you have a company that does that right now, doesn't have much income to show. Your return on equity that you will see the most recent year will be low, right? You can't use this equation to actually get growth in that company because for this equation we were used, and I should have mentioned this up front, your margins have to be stable over time. This is designed for a company in steady state. And the company you've described is a company where if the investments pay off, you should expect to see your margins climb over time. Maybe not the next year, the next 3 years. So I'm going to give you a more general version for companies where margins are changing, where you come up with growth in revenues you build down to cash flows. Because you can't use this equation for any company with margins that are shifting. In fact, to talk a little bit more about the return equity calculation, let's say your company is a 15% return on capital. Cost of debt after tax of 5%, debt to equity ratio of 100%. You know what the return equity is going to look like for the company? I made the numbers nice, round numbers, you don't need to calculate. 50% return on capital, debt to equity ratio of 100%. And every dollar they borrow, they make a 10% spread over the cost of it. Company's return equity is going to be 25%. 15% plus 1, the debt to equity ratio is 100% times the 10% spread. That's magical, right? If they make the debt to equity ratio 200%, the return equity will become 35%. And when you do something like LBOs, you can see why the return equity very quickly can look amazing, right? 80% return equity. It's kind of deceptive because it looks great until you bring in the other half of the equation. Because otherwise, if you just compare return on equity for these companies, the company with no debt will always look less attractive than the company with debt, at least in good times. And you'll end up overvaluing the second company if you don't factor in the higher cost. One final point about growth, and with both Deutsche and Tata Motors, I estimated growth in equity. With Disney, I wanted to estimate growth in operating income. So here I looked at reinvestment rates. So how much of the after-tax operating income do I put back in the company? Net capex to change to working capital. It's about 54%. And the return on capital, it's exactly the same the return on capital I used to look at Disney's excess returns like 15 sessions ago. It now comes back to help make a judgment about future growth. If I assume Disney's margins are stable, that's a big F, 12.61% times 54% gives me a growth rate of 6.8%. How much are you reinvesting? How well are you reinvesting? How you measure those will depend on whether you take the equity route or the firm route, but you're still following that principle to get in steady state. This is going to be where your head is. Your growth is going to be driven by what kind of returns you make on your project and how much you invest. I actually use that as kind of a way of, just checking when a company throws out a growth rate. If we can grow 35% a year and the return on capital is 11%, the only way you get to 35% growth is by pumping up margins. And if the existing margin is already at high levels, the question you got to ask is, where is this extra oomph coming from? How are you able to grow at 35% a year? So if nothing else, allow you to ask the right questions about companies. Are there companies that can grow fast with very little reinvestment? Yes, you're an infrastructure company. You've already done the reinvestment over the last 10 years. Your expected growth for the next 10 can be high, even with the low reinvestment rate, because your margins are going to pick up over time as your revenues start to come. But keep this as kind of the sanity check on growth rate. Is my growth rate viable in the long term by looking at what they're investing? But the point is, there are companies out there with margins that are changing. Yes.
Can you confirm again, how did we get the reinvestment rate in this in the case of?
That's a net capex, capex minus depreciation. That's a change in working capital. That's the after-tax operating. So just like when I do retention ratio, I look at what I'm retaining divided by net income. Here I'm looking at what I'm reinvesting divided by my after-tax operating. So when you do free cash flows, it's right there, right? So if I have after-tax operating free cash flow, whether you like it or not, you tell me how much you reinvest. That's what I'm capturing as a rate, because that rate will allow me to come up with the growth rate. So look at both the dollar reinvestment and that rate, because it's going to be both are informative in different ways. Now, when everything is changed, which is going to be the case, in fact, the spreadsheet that I'm sending you is for the most general case, because it works for every company. Let's say you have a money-losing company right now. Return on capital, that reinvestment rate is not going to work for you, right? Because the return on capital for a money-losing company is negative. The reinvestment rate is negative. You might think this is very convenient. Negative times negative is positive, but taking a loss and making it grow will just make it a bigger loss. When you have margins changing, you have to climb the income statement. What does that mean? You got to start by projecting revenues, right? If your margins are changing, your growth rate can't be in income, it's got to be growth rate in revenues. You start with growth in revenues. Where will that growth come from? You'll have to look at how big your company is, how big the potential market is. And that's why many of these young companies make this big deal about total addressable market. Look how big our market is. We can grow a lot. You don't have to fall into that trap, but it is a fact. So the first step is you project out revenue. For some companies, it's going to be really high. If you have a young growth company in a big market. For some companies, it's going to be lower because you're a mature company. For some companies, could it be negative? What kinds of companies? We use a negative revenue growth rate. You have a tobacco company. What's the end game that you see? Fewer people are smoking, they're older, and as they move off the earth, your potential market is shrinking. You're a fossil fuel company. What's the end game? You might actually end up getting smaller. So leave open that door for your company that if it's a shrinking company, you will use a negative revenue growth. I often ask people to do DCFs every day of their lives. They've been doing it for 30 years. Ask them, how many times have you valued a company with negative revenue growth? You know the answer I almost always get is never. And I said, don't you think that's strange that you never see to run into declining profit? Because in the real world, there are companies that shrink. So how come you never ever encounter these companies? The answer is psychologically, it's really difficult to put in a negative number. As human beings, we're hardwired to be optimistic. So this seems almost unnatural that you put a -3%. So revenue growth will be determined by your company in the market. Then you look at margins, right? You've got your margin right now. You say, what will the margin be 10 years from now? Could it stay the same? Yes, some companies are saying we're in a stable market, things are not going to change much. The margins for beverage companies are not going to shift because they've been pretty stable. We take Facebook example, right? You could argue that margins could change. In the case of Facebook, I think they're going to decrease. And here's why. Their existing business is one of the highest margin businesses I've ever seen. Online advertising, their actual margins are like 53, 54%. Now, of course, with the privacy constraints are coming in, the laws that are passed, you could argue those margins are going to decrease because I don't know what Facebook will have to do, but they will have to spend money to put in these privacy restrictions. In the case of Facebook, the margins might go down. In contrast, you look at Peloton. The margins in 2021. Well, look, why? Because the business model is in flux. If you're upbeat about Peloton, so they're going to move towards a subscription model over time from what they have right now, which is mixed equipment / subscription model to a pure subscription model. Their revenue growth might slow down because the subscription model will mean that you give up that $2,500, bike and $4,000 treadmill going into your revenues. But your margins might be much higher because the subscription business is much more profitable than a fitness equipment business. I mean, I remember I talked about stories, how they drive valuation. You cannot value Peloton without a story about where the company is going. And that story is going to play out in revenue growth, it's going to play out in margins, and it's going to play out in reinvestment. And the way I capture reinvestment is I look at what your revenues are growing at and say, how much will I need to reinvest to get those revenues? The ratio that you will see in the spreadsheet is sales to capital. Don't let it intimidate you. The denominator there is the same denominator we use for return on invested capital. It's book value. But instead of looking at income versus that, I look at revenues. So the higher that number, the more efficiently you're delivering revenues. So for every dollar of capital, you deliver $5 of revenues, you need to reinvest. So tell your story about the company. Think through what does it mean in terms of growth, margins, and reinvestment, and you've got the free cash flow. This is where valuation gets made or broken. Focus on that part of the exercise, and you really are getting to the heart of valuation. So the case of Baidu, where the margins were, I assume margins over time will come under pressure. The margins decreased from 49% down to 35%. Why? Because at the time that I did this valuation, Baidu dominated the Chinese market. There absolutely no competition, but you could see the beginnings coming in from Tencent and Alibaba kind of trying to eat into their online advertising. So I'm telling a story of high growth. Why? Because it's China, big market, declining margins, and a relatively low reinvestment because it's not a capital intensive business. So based on my story for Baidu, I have expected cash flows that started about 11 billion and climbed to 38 billion over time. Because what you're getting is a combination of things. One is much bigger revenues, lower margins, but as the growth levels off, they need to reinvest less and less because they have fewer ambitions. Cash flows per discount rate. Any questions on growth? So for your company, I want you to start thinking about what will revenue growth look like for my company? What will happen to margins over time? And think out of the box. You're not constrained by what's happened in the past. Make your best judgment. Let it go. There's what I call a karmic point evaluation where you say, I've done all I can. The rest, all kinds of things can happen, right? You value a hotel in 2019. You know what you forgot to factor in? There was going to be COVID in 2020. I can't pick on you for doing that because nobody did. You cannot hold yourself responsible for things that happen that are in a sense out of your control. You can make your best judgment, you come up with a value, and accept the fact that you're going to be wrong. What percentage is that? 100% of it. You know what? Because you're not God. If any of you are operating under that delusion that you are God, then I'll let you go. And if you have other problems that you might have to deal with therapists, but I mean, you're going to be wrong because you can't forecast the future. All you can do is make your best judgment. Which brings me to the elephant in the room. Discount rates, cash flows, growth rates, and then you got this big number at the end, the terminal value. The most used and misused number in valuation. Because to make that terminal value calculation, I've got to make that assumption that your cash flows can grow at a constant rate forever. Why? Because without that, I can't get mathematical closure. This equation, as I said, is the present value of an infinite series in mathematics. And it allows me to say, look, I'm done in the year 10. The cash flows will keep continuing, but this is my value in the year 10. Now, I don't know how many of you have past life as bankers, but bankers actually use another approach for estimating terminal values that I think is valuation malpractice. How do bankers get terminal value? They use multiple, EBITDA multiple, revenue multiple, book value multiple. If you do that, you really are not valuing your company. You're doing a pricing of your company and passing it off as an DCF. You have no choice. You have to use this assumption of stable growth. Having said that, though, let me add a few constraints. If you tell me your cash flows are going to grow at a constant rate forever, that rate has to be less than the growth rate of the economy in which you operate. I'm amazed at how many times I get pushed back on this, right? There's a mathematical reason why that has to be true, because if you let your company grow at a rate faster than the economy, it's going to become the economy. Then what? It also means that once you put your company into stable growth, it's got to have the characteristics of a mature company. Like what? It can't be earning 80% returns on capital. Mature companies don't do that. It can't have a cost of capital of 15%. In dollar terms, because that's a very risky company. You got to give it the characteristics of a mature company. So one of the challenges we face in valuation is, when will that happen? When will I become a mature company? So let me ask you a question. When will ExxonMobil become a mature company? It happens 5 years. It's beyond mature now. When will GE become a mature company? That's like asking an 80-year-old, when will you be middle-aged? Right? 80-year-old looks at you and says, probably get beaten up with a cane when you ask that question. Because that was 45 years ago, 30 years ago. So there are some companies you can already put into stable growth. There's nothing there. I'm inclined to put companies like Coca-Cola and Kraft Heinz, McDonald's into stable growth sooner rather than later, because they're closer to that point in their lives. And that's growth companies. So when you make that judgment, basically this is how it plays out. If your company is already in stable growth, you can go directly to the terminal value calculation. There's no need to project out numbers for the next 10 years because you're already there. If your company has some growth, take Levi Strauss, for instance, right? It's a pretty mature company, but Asia has been its weakest market. So to the extent that you think that Levi Strauss can find some growth in Asia, you might say, I'm going to give them 8% growth for the next 5 years as they try to expand in Asia. But after year 5, I'm going to push them down to a stable growth company. It's called a two-stage model. Essentially, a first stage of growth and stable growth. But for most companies, you're sitting there saying, well, stable growth is not going to happen until year 10. You let your growth rates change over time. And as they change over time, eventually the company becomes a mature company. That's the 3-stage, 4-stage, every DCF model. Basically, this is one of the things that drive you from where you are today to becoming a stable growth. Of course, whenever I say this, somebody always pushes back and says, what if my company will never be a stable growth company? Because in every market, there are always some company going to say, that company will never be a mature company. So special. When I started valuing companies in 1981, people used to say that about IBM. People forget this about IBM, but IBM was one of the great growth companies of all time through the 20th century. It maintained double-digit growth 30, 40 years. In 1981, never be a mature. By 1986, IBM was wishing it could be a mature company because its growth rate is -3%. Then it became Walmart. Walmart was one of the great success stories. Walmart was never be a mature company. Such an amazing company. I agree it's an amazing company, but eventually, you know what makes every company a mature company? Is the longer you're successful and the more you grow, what happens to you? The bigger you get as a company. Eventually, your scale starts to get in the way. I don't know why people are so surprised that Netflix is having trouble getting double-digit growth in users. When you have 250 million users, what does double-digit growth mean? You have to add 25 million users next year. Where the heck are they going to find 25 million users? Definitely not in the US. There aren't enough users. So guess where they have to go? They have to go to a place where you have numbers. You can't go to Slovenia. There are only 3 million people in the country. You got to go to India. You got to go to China. You got to go to Brazil. And you very quickly start to run into brick walls. You can add the 25 million in India, but the Indian user pays only $3 a month, not $19 a month. You might be able to deliver the users, but your revenues are no longer going to grow at the same rate. Eventually, this happens, and whenever it happens at companies, people always claim to be surprised. I never saw this coming. How can you not see this coming? It's mathematical. It's going to happen at every company. And it happens in entire countries. I hear people saying, I'm surprised China can't grow at double-digit rates. What's so surprising? You're the second largest economy in the world. How the heck can you grow at double-digit rate unless the rest of the world goes into depression? There's only so much global growth to go around. So eventually a company will become a mature company. And the follow-up then is, how long will it take for my company? Remember, when you think about growth, it's not growth per se that creates value. It's growth with excess returns, being able to earn more than your cost. And when we talked about excess returns, I said, don't look at the number, look at what competitive advantages this company has that allow it to earn excess returns. I don't have much use for strategy in my class, but this is one of those few places where I'm going to let you bring out your strategic buzzwords. The strategy is all about buzzwords, competitive advantages. So you can talk about brand names, you can talk about whatever you want to bring into the picture, great management. I'm going to look at the competitive advantage, and the stronger that competitive advantage is, the longer I can let you grow. If you're Moderna, what is it that allows you to allow the company to grow for the next 10 years at very high rates? The fact that there's a patent protection on mRNA, and you've got the patent on them. So that is a very strong competitive advantage. With Coca-Cola, what allows them to grow faster than the economy for a long time? Brand name. And don't underestimate the power of brand name, because it's magical. Once you get it, it allows you to charge higher prices. So don't make valuation all about numbers. Ask yourself, what is the competitive advantage? With some of the younger companies, it's going to be tough. What's Peloton's competitive advantage? Anybody have a Peloton? What's Peloton's competitive advantage?
Community, it's instructor.
It's a fact that it's the instructor base. It's the only fitness, fitness program out there where people, my wife and daughter, they don't have the Peloton equipment, but they cheap out and use the $13 subscription. And all they talk about is so-and-so. I'm thinking, I have no idea who they're talking about. But the fact is the trainers have become a significant competitive advantage. Now we can ask, how long will that competitive advantage last? Because when you're a big name celebrity trainer, you know what you're going to get. It's obvious, right? Nordic Track wants to start a new business. They're going to come and offer you $1 million. But think about the competitive advantages. Ask how long will that competitive advantage last? Because that's what's going to drive whether you give this company 10 years of growth, 15 years of growth. Yes.
How do you assess whether a company has reached the mature stage?
Well, one is, you can look at the facts. Revenue growth is already in single digits. There's a clue there, right? Facebook last year had single digit revenue. I think it's closer to being a mature company than most people realize. Google is getting very close then. Why? Because it's online advertising. Google and Facebook already dominate the market. How do you get additional growth? Where do you go for growth? So sometimes looking at the size of the market and what your company has done in that market already gives you a sense of whether you're approaching the brick wall of stable. Now for my companies, here's a choice I made of how long to wait before putting them in stable growth. When I looked at Disney, already a big company that kind of weighs against is one of the largest entertainment companies. It's earning well above the cost of capital. That's good news. So I looked at the excess returns. I looked at their competitive values. Do they have strong, absolutely. They have some of the best known, I don't know what to call them brands, but you can't recreate Mickey Mouse out of nothing. I did give them a 10-year growth period, but not a high growth rate. It was about 6.8%. So I'm not getting carried away, but I'm saying I think they can maintain that because of their competitive advantage. So in spite of being a large company in a pretty mature market at that time, I thought they could get to 6.8%. When I looked at Vale, I very quickly realized there was nowhere to go. They were the largest iron ore mining company already in 2013. The iron ore market is not getting any bigger. If anything, it's getting smaller as China leaves its infrastructure spending behind it. For Vale, I basically made them a stable growth company right away. I said there's no high growth left in there. It might come if iron ore prices pop here, but that's going to be temporary. It's not going to be a long-term source of growth. For Tata Motors, it is, if you think about just the Indian market, it's pretty much going to be able to grow at the size of the Indian market. And that's a plus because the Indian automobile market is growing, but it's also facing a ton of competition in the Indian market. So if you weigh that off, well, I'll give them higher growth simply because of the potential market growth. But the Jaguar Land Rover creates a different dimension. If they can find a way to grow the Jaguar Land Rover sales, perhaps, but I think on both dimensions, they're going to very quickly start to run into brick walls because this is a competitive business and the total market is not growing that fast. So I gave them 5 years of growth before putting them in stable growth. In the case of Baidu, the youngest of my company, the search engine right now doesn't pay dividends, reinvest everything back. China is growing as, at least in 2013, tremendous growth happened in the underlying market. I did give them 10 years of growth. I almost never value a company with more than 10 years of growth. Why? Not because there aren't companies that grow for longer than 10 years. Obviously there are, right? We can name them. Microsoft, Walmart. The fact that we can name them tells them something about these companies. They're the exception, not the rule. You don't want to value a company to be the exceptional company up front because then where's your upside? If anything less than exceptional then, it's going to be disappointing. So let's start with my Vale evaluation. As I said, it's a mature company. I'm going to give it the characteristics of a mature company. Now, when you want to value a company with a stable growth model, you want to make sure the inputs that go into that model reflect what this company can maintain forever. It's kind of a heavy load to carry. You definitely don't want to take last year's numbers and just plug them in, because God only knows whether the company can maintain them forever. So I did some smoothing. I looked at the average return on capital that Vale had earned in the previous 5 years. I looked at the equity risk premium and the cost of capital. So that was pretty conventional. But I used that average return on capital as my basis for my valuation. I assumed that Vale would grow at 2% a year in perpetuity. 2% is basically the inflation rate in 2013. I'm assuming that iron ore prices would kind of keep up with inflation. You think that's pretty pessimistic. Take a look at my final valuation before you accuse me of being pessimistic. But if I use that 2% growth, I take their operating income and adjust for taxes and reinvestment. And this is where the return on capital comes in. 2% growth rate, 17.25% return on capital means that they have to reinvest at least 11.6% of their operating income every year in perpetuity. When you're doing stable growth, a terminal value, you got to make sure every single input is a number that can be sustained. So I'm going to tie things up with that sustainable growth equation. And what I get as a present value, assuming this growing perpetuity, is $203 billion. That's not the value of my equity. That's the value of the operating assets. To get to the value of the equity, I have to add cash, I have to subtract out debt. But after I cleaned everything up, the value per share that I got was $32.44. The 44 cents is false precision. It's around $32. And that's with a 2% stable growth model. The reason I keep emphasizing how conservative the model is, the stock was actually trading at $14. One of the great mistakes of my life, I bought Vale in 2000. Just 2 years later, what the stock was trading at? $5. That's the wrong direction, in case you're wondering. Because if you buy something, you want the stock to go up, it went in the wrong direction. In fact, in 2015, I wrote a post called No Mas, No Mas. Basically indicating I'm ready to throw the towel. It's clearly I screwed up. And I actually went back and looked at my Vale valuation to see what I missed. And what I missed was the fact that it takes about 2 years. When I valued Vale in 2013, I assumed that low iron ore prices that were out there were already reflected in their earnings. You know what I was missing? With commodity companies, it takes about 2 years before low prices show up in your earnings because they often have forward contracts that lock in existing prices. I learned the lesson the hard way because 2 years later, I was still getting paid from iron ore prices going down 2 years. I mean, I rebought Vale at $2, but the basic mistake I made here was not right. So this earnings that I have here were overstated because they didn't reflect the pain that was to come that I could have forecast based on what iron ore prices had done in the last year. So this kind of cash flow model, stable growth model for a company that I think is already a mature growth. Now for Disney, because I have to wait 10 years. Yes.
Good question on the last slide.
Yeah.
So the key assumption is the growth is behind the company and the operating margin is going to stay the same. Is that accurate?
Anytime you stable growth, all those things are implicit have to be true. Because in stable growth, everything has to grow at the same rate, right? Because if your revenues grow at a different rate than operating income, the value is going to blow up. The forever makes this such a constraint factor. So if you have a company where you do the least amount of doubt about any of those things, that's why I make the spreadsheet I'm going to send you is going to work for a stable growth company. It'll give you 10 years to fix the things you think need to be fixed before you can put the company in stable growth. So you think the margins are going to rise? Don't use the stable growth model now. Put the margin rise in, even though the growth is low. And then at the end of year 10, you can say, now I'm ready to use the stable growth. You're assuming the cost of capital will be the same, the reinvestment rate will be the same, the return on capital is the same, the margin will be the same. All those things are implicitly always assumed and use the stable growth.
Yeah, to follow up. So this value of operating assets is the terminal value, is what we are.
No, this is the value. Remember, there's no such thing as terminal value, right? Because if I take next year's earnings and I use this equation, I'm getting the value as of right now. Your terminal value is as of right now, right? There's no growth phase. All you get with this equation is the value at the start of the year. And since I'm doing this for year one numbers and projecting them back today, the present value is already today's value. So the terminal value and today's value are the same in this case because they don't have a growth rate.
I'm curious, what is the second term there? I'm getting confused by one.
This is the tax rate. 20.92% is the effective tax rate. So basically, I take the pre-tax operating income, I net out the taxes, then I net out the reinvestment. So basically, it's just a way of getting to my free cash flow. Now for Disney, I'm going to wait until year 10 to make them a stable company. But because it's year 10 and things are changing, I have to remember to give them the characteristics of a mature company. So here's what you're going to see. One is, as I go through time and I look at the growth rate, I'm going to use a growth rate that it's steady state that I can sustain forever. So right now, I give them a 6.8% growth rate, but I can't leave that growth rate at 6.8% a year forever because it will blow up my valuation. So I'm going to suggest a cap that I might have suggested earlier when we talked about implied equity risk premium, maybe you remember, that when you want to project out how high that growth rate can be that you can sustain forever, that you take a look at your risk premium. Why? Because built into the risk-free rate is expected inflation and an expected real interest rate, which over time is actually a pretty good proxy for the growth in the economy. So today, if you're valuing companies in the US, in US dollar terms, and you're putting in a stable growth rate, that growth rate is going to be roughly 3%. That's what the 10-year bond rate goes. Yes. If you've been valuing the same company on January 15th of this year, that cap would have been only 1.5%. So the T-bond rate started the year at 1.5%. You see, that's bad. My discount rate went up. But when you do your growth rates, I'm now going to give you this at least partial compensation saying the discount rates have gone up, but you can now use a higher growth rate. So obey the cap when you think about stable growth. Second, I've got to ask what kind of returns over and above the cost of capital will Disney make in perpetuity? McKinsey actually has a very clean answer. You know what they tell? Have any of you read the McKinsey valuation book? They tell you that mature companies can't earn more than their cost of capital. So basically the return on capital, when you do terminal value, drops to your cost of capital, which to me is a little too rigid because there are some companies that earn well above their cost of capital even after they become mature companies. Think of Coca-Cola, right? It's not going to earn a return on capital equal to the cost of capital tomorrow, even with its growth rate dropping 2%. So I'm going to give you some discretion. I'm saying, is this company that you're looking at the kind of company that can earn more than its cost of capital in the long term? And the answer is yes. Then you can leave the return on capital above the cost of capital, but maybe think of bringing it down. So if you remember, I started my calculation with the return on capital of 12.6%. That's the existing return on capital. But when I move towards my terminal value, I'm going to drop that return on capital to 10%, still above the cost of capital, but not all the way down to the cost of capital. You're going to see how this plays out in valuation when I show you the terminal value. This is a misconception in valuation that mature companies don't have to be invested. I've seen discounted cash flow valuations where people say net capex is zero, change in working capital is zero because it's a mature company. If your net capex is zero and you change in working capital is zero, your reinvestment rate is zero, right? If your reinvestment rate is zero, it's the only growth rate that's consistent with that reinvestment rate. Zero. If you're using 2%, 3%, you build a valuation that's built to blow up. So if you want a 2.75% growth rate as I do, or 2.5% growth rate as I do, you basically have to reinvest enough to get that growth rate. So how do I know how much to reinvest? This is where my return on capital calculation comes. Because I'm earning a 10% return on capital, I will have to reinvest 25%. Now you see what would happen if I took Disney and pushed the return on capital all the way down to my cost of capital. If I earned a 7.29% return on capital, I would have to reinvest more. If I reinvest more, I'd have less cash flows. So if less cash flows and lower terminal value. Everything's linked together to the ultimate terminal value. And finally, I lower the cost of capital to 7.29%. So lower growth rate, lower return on capital, different cost of capital. Basically, I'm looking at a very different company 10 years from now than the Disney I'm looking at. Now, when you value equity, one of the nice things is you take the present value of dividends, you come up with the value today, you're done. That's the value of your shares. When you value free cash flow equity, you're pretty close yet. You take free cash flow equity, discount the cost of equity, you're pretty close to being done. But when you take free cash flow to the firm and discount at the cost of capital, you value what I call the operating assets of the company. And the reason is very simple. What did we start with as our measure of earnings? Operating income, right? So let me make a statement that's going to sound completely innocuous, but it's going to have consequences. When you start with operating income, what you valued are only those assets whose earnings are part of operating income. There are assets on your company's balance sheet whose income doesn't show up as part of operating. The case of Apple, you know what I haven't valued yet? When I started operating, the 200 million in cash. Why? Because the interest income from cash shows up below the operating income line. So when I start with operating income, I haven't counted it. So I've got to add cash. In the case of Tata Motors, you know, in addition to cash, what I've not valued yet? Tata Motors has holdings in 35 other Tata companies. They're minority holdings, 3% of the company, 5% Tata Steel, Tata Chemicals. Those are called cross holdings. Income from cross holdings show up below the operating income. So if I have cross holdings in other companies, I have value those here, I've got to bring them in. It's a lot of cleaning up. Do I have cash, do I have cross holdings? Then you have to subtract our debt, because obviously what you get here. And we talk about what happens when you own 60% of another company and you can sort of create an entirely new mess to deal with in terms of what happens to the remaining 40%. But you got to clean up as you go through, because what you get is your bottom line will be the value of it. And there's one final step. You have 100 million shares, and the value of equity is $1 billion. And ask you what's the value per share. What do? We take the billion, divide by the 100 million, and then come up with $10 per share. Let me throw in a wild card. Let's suppose this company has been giving options to its managers as part of their compensation plan. Those options are not part of your share count because they haven't been converted. Do you think your value per share might be affected by the fact that will it go down or up after this increase of it? It will go down because you've given away a slice of my equity. So if you have options outstanding, I'm going to value those options, take them out of your billion, saying that no longer belongs to me as a common stockholder. It's amazing how much damage is done in valuation after you tell them you're done. Because here's what happens. You spend all this energy estimating cash flows in this context. You come up with the present value and say, oh my God, I'm done. And then you start to get really sloppy about cash, cross holdings, and options. You can take days of good work and ruin it all because you're being sloppy. So we'll come back and talk about how to clean up for those, but that's going to be the bottom line of the valuation. So I want to stop there, and I will make the last part will become part of the closing presentation. But I want you to think about your company, tell a story. Don't put the weight of the words. I know this is the very end of this class, so I'm not going to hold you. No, I'm not going to ask you questions I would have asked if this were a valuation class about some of the inputs. I'm going to cut you a lot of slack in making judgments that are your judgments. But start to build a story and convert that story into numbers, because that's ultimately what's driving your valuation. Okay, I will see you on Monday.
Hi, Professor.
Yes. Go ahead.
I have a question about the model for valuation. Do you input sales to capital ratio? What is that for?
What sales, that's to estimate your reinvestment. So that's what I use to estimate your reinvestment each year, because if your revenues are growing, I'm asking how much will I need to reinvest. So you give me the sales to capital ratio that allows me to take a change in revenues and estimate how much you need to reinvest that year. So let's take an example. Let's say your revenues grow 300 million. You have a sales to capital ratio of 3. That basically means you got to invest 100 million. So that becomes what you subtract out from after-tax operating income to get to your cash flow.
So here capital is your invested capital, or?
The invested capital. The same invested capital used to compute return on capital. It's the same denominator, but the numerator is now revenue.
So how would we project out that